Hello everyone, this is Margaret Young from CMC Markets. Today is 11th of March, Wednesday, and we have just had the two most volatile weeks in more than a decade. I think since I joined this brokerage industry in 2011, this Monday is the worst trading day ever in my entire career. I have never seen volatility like this. And on Monday, we saw that crude oil prices tumbling over 30% within 24 hours, and US market closed 7% lower and hitting circuit breaker twice in a day. So this is unprecedented in the last decade, and all it has to do is the question that will this COVID-19 pandemic lead us to a real recession that has never seen in more than a decade. So right now, the situation isn't great. Let's take a look at this is according to BBC, the latest update of coronavirus. This epidemic has spread out widely around the globe, more than 100 countries, and the numbers outside of China is climbing really fast. Italy, the number has hit more than 9,000, and more than 600 people already died from this. And you can see that Korea, Iran, France, Germany, and more importantly is the number in the United States. Well, I think this is worth of concerning because US is the largest economy in the world and the largest consumer market in the world. And also, right now, the US government, they haven't really taken any solid measures to contain the spread or any distance measures to stop people from going around. So there's a chance that we can see this number in the United States going up a lot faster in a weeks or months to come. So this is the main driver behind this huge market sell-off we have seen in the last 2 weeks. So from the peak till this Monday, the S&P 500 index has already fallen around 20%, means from here to here, we have likely entered into a technical bear market for the US. So this is pretty concerning, even though that on Tuesday we saw a technical rebound, but this rebound didn't last for long. Today the market sell off quickly, and the momentum seems to be pointing to the downside. That means market may have some more room to go down. And here I have drawn this Fibonacci extension downwards. So this is a downward projection, see where the market is heading to. And because because there are a couple of long bearish range bars, so from a technical perspective, there's a chance that US indices can drop further to this level, 100% Fibonacci extension, which is pointing to very close to 2,600 points. And if this support level is broken, the next level could be somewhere here, okay, 2,265. You may think that, oh, this is too much, the market may not drop until that level. Let me show you a bigger picture, which is here. So from 2007 till now, right, since the last financial crisis till now, S&P has climbed from 800 points to 3,400 points. That's recent high, and we are now only here. All right, we are now only here. We have dropped more than 700 points from here, and in the last round of financial crisis, S&P has actually fallen from 1,600 to 800. Okay, that's nearly 50% correction, and we are right now somewhere here. So from this historical perspective, do you think the market have more room to go down if we are really moving closer to a recession? I think the answer is yes. Green line here is the volatility index VIX. So VIX on Monday has spiked up to 45, but this is not even close to the peak we saw in 2008, which was at around 70 to 80, and the recent high of VIX is 45. All right, so we are not yet close to that level yet. But the outlook is pretty worrisome, I would say, especially that based on recent update from the White House, President Trump doesn't seem to be very concerned about this virus. He says everything remains to be good, and he's going to carry out some kind of fiscal stimulus, tax cuts to show up the growth. I think he's trying to stop the market from falling, but I don't think that any forms of physical stimulus will have to prevent the virus from spreading. They need to take some really good measures to contain it. So because I do this YouTube video perhaps once a week, but I'm a lot more active on Twitter. I do tweet about 4 times a day. So for those who are interested, you can actually add my Twitter here at MargaretYJY, and you can see that I've posted some interesting figures and thoughts here, including this. All right, I think this is quite worrisome. A recent analysis showed that this virus outbreak in Italy is very close to what happened in Hubei province of China if the figures are pushed back by 37 days. So the trend is extremely similar to each other. And also the population of Italy is around 60 million, whereas the population of Hubei, China province is 58.5 million. The population size is extremely close to each other, and so from here it may suggest that the worst is not here yet, and we may see the number climbing a lot higher before it drops down. That's for Italy, and Italy now has been completely locked down, and I don't think that it is the last country in the European zone that carry out a lockdown policy. So more traffic bans, more controls measures will be taken, will be carried out by the governments, and this will bring very bad impact to the economic growth and normal business activities. All right. So in terms of monetary policy, we are seeing that the futures market are now pricing in a very high probability of Fed cuts on the 18th March FOMC meeting, which is next Wednesday, a week from here. Right now, the Fed rate is between 100 to 125 bips, and the forecast for the next meeting is somewhere between 25 to 50. Means there could be a 75 bips to 50 bips cut in the next week's meeting, on top of the 50 bips cut we already seen like a week ago. So how would this affect the market? Basically, we are getting closer to a zero interest rate environment, which is bad news for banks because they are living on the net interest margin. So a dropping interest rate is going to hurt banks' profitability very badly. And on the other side, it's perhaps a good news for properties and real estates, and in Singapore's context, REITs counters. And also, we are seeing that the dollar index has fallen sharply. Okay, so this is the US dollar index. We saw that the dollar is moving in tandem with the stock market, and this huge sell-off in dollar index is reflecting market's expectation for more Fed rate cuts. So besides of this, I'm also observing changes in Fed's asset purchasing. So the turning point is actually September last year, when Fed stopped shrinking its balance sheet. Instead, it started daily repo operations in the market by buying back assets, buying back securities and bonds from the open market. That's where this asset started to increase. So by doing so, Fed is actually injecting more and more liquidity into the financial market, and I would foresee this asset balance to increase further as Fed is now carrying out aggressively asset purchasing programs. So this is another way of quantitative easing. They are already started to do this. How would this impact our market? Is that gold price has been doing pretty well recently. Gold price has been climbing up even though that recently it came off a little bit, but the mid to long term trend is positive because of all kind of monetary and fiscal stimulus. So in a very short term, I think gold is facing a resistance at 1680 around here, and suggested by CMC's super trend, it has flipped downwards right recently after it failed to break out this level. So 1680 might be a near-term resistance level, but in a mid to long term, I think gold will eventually break out and move higher from here. Okay, then finally let's take a look at Hong Kong's Hang Seng Index. Well, Hang Seng has been dragged down by US market as well as a very bearish global sentiment, and recently it has tested this support level twice at 25,900 points and failed to stay above this level. On Monday it actually break down this level, and Monday dipped down further. So this previous support level has now become a resistance level, 25,900 points. The short-term momentum points to the downside. Alright, so that's all for my part. Last but not least, do remember to follow my Twitter, and also please also follow CMC Singapore's Twitter. Alright, we have been all very active in observing the market and send out quick market updates every day. Thank you.